Welcome to another episode of How to Make Money with Hard Money. I'm joined here by my partner, Caleb Delgado, and our development partner, Mike Jones. Welcome, Mike.
Thank you.
Back on the podcast a second time, I believe.
There we go.
We wanted to talk today a little bit about, some lending industry insights, how the hard money lending market has changed over the last 5-10 years, and some of the things we've seen in the market. So I guess, Caleb, we'll kind of start with you on, maybe you can break down DKC Lending's vision and mission and values to start with.
Yeah, well, here at DKC, we strive to be the leading hard money lender in the state of Florida and also a visionary in the industry. That's basically what we would like to do. But, that's it.
Love it.
So let me ask you guys a question. What inspired you to originally start DKC Lending?
Yeah, good question. I think for us, Caleb came from the conventional mortgage world. I had a development background as well. And so I think we both coming together, we had different perspectives on hard money lending. And we tried to fill a void that we felt was missing in the market at the time. Mm-hmm. And so, there's certainly the conventional banking institutional options, and there were some private options that were perhaps, some would consider outdated even. Yeah. Where, you had a lot of attorneys and high net worth investors who would provide loans privately. Sure. And so we tried to kind of bridge the middle and say, how can we provide like a true private asset-backed lending product to borrowers with more of an institutional grade feel to it, and like have reliability to the product, and, not when, if somebody's lending and they're out of money, catch me next time type of thing. And so we try to kind of make it more consistent and also have that customer service experience that was kind of missing in the private world.
So you saw a gap in the market, and then that's what inspired you to fill it.
Yep.
Now, Caleb, I know you've got a big background in the conventional space. What inspired you to step into the private money lending space from the conventional world?
Regulation. Okay.
Not one for regulation.
Not one for regulation and rules and all the things in between. But no, really specifically, 2008 happened, right? In 2008, we seen a big crash, and a lot had to do with the subprime market. Anybody who was ever involved in the subprime market knows it was people with less, lower credit scores, less qualified to get loans, a lot of stated income documentation style loans where you kind of tell the bank what you make versus showing your income documentations for proof. So when the market crashed, and people were misusing those products, it left a lot of people who did use the products correctly with the inability to get financing. Okay. And that's where hard money lending really, I think, originated.
Yeah, you say it's a lot of times like the replacement of like the subprime market, right? I've heard you say that quite a few times.
Yeah, that's really what it was for me in my experience. And then when David and I got together, we started seeing investors loving to invest in real estate, but at the time wanted it more passive. And then we had real estate investors who needed looser regulated loans to invest in real estate. And that's where we kind of bridged the gap with our hard money lending products. And we've seen a ton of success in it. And really all based around speed too, because when you go for banking regulated loans, that's 30 to 60 day products. When you're investing in flipping real estate or trying to capitalize on a deal that needs to close in 10 days, hard money loans are tough to compete with.
Yeah, speed is everything for sure.
Yeah.
What was one of your biggest takeaways from that time when you saw the market crash, and just like making that pivot and understanding, what was going on in the market and what was the next play for you?
I think the biggest thing was settling into the changes, and the change was uncertainty was here. Okay. What people were used to, the way the market moved, it was just a total unprecedented moment. So understanding that this can happen at any time.
Sure.
And not to be afraid of it, really just embrace it and understand that the market will be here. It's not like all of a sudden things crash. Now no one has a place to live. It's okay. Now we go through change, right? And just adapt with the change, embrace the new prices, embrace how mortgages are underwritten and the qualifications, and then really find our niche and how we fit inside the market. The market's never going to change for you. Right. You have to adapt to the market.
For sure.
So really just embracing that change, not getting myself all worked up and not letting the uncertainty overwhelm me to the point that I'm paralyzed and don't want to be in the industry anymore.
I love that.
One of the great things that I think that was a great marriage for underwriting and David and I's partnership was I was always operating loosely, but I always wanted to do more volume.
Cowboy style.
Yeah, cowboy style. I was kind of one of those guys. But one of the things I wanted to talk to Dave, because how our partnership, I thought, really helped us flourish, was how you helped, basically control my vision and our vision together to be able to consistently multiply the volume by process and procedures.
Yeah, well, I think a lot of it starts with the money, right?
Right.
So, being young and having to raise a lot of capital, and our investors invest in a product. As much as I'd like to say they love Caleb and David, I think our investors invest in a product.
For sure.
And so I felt like we had to structure the product the right way to provide protection for our investors who want to invest in these hard money loans. But at the same time, the borrowers need a product that they can actually use. And so like basically coming up with, like, we have two clients in every transaction, our investors and our borrowers. So, I mean, that's kind of where it started from. And it was like, how can we protect the investors, but provide the right product to the borrower that they actually can use?
Nice.
That's how I would say that.
Okay. And Dave, what would you say over, like, I guess a better way to put it would be, let's give the audience some context about the hard money industry in general over the last decade, and what are some trends or things that you have seen, how it's developed over the last decade?
Yeah. So like right now it's changing a lot. In the last 5 years, I mean, it's changed a lot. When I'm younger than Caleb, but when, he's talking
always
about
has to point that out.
I'm just more handsome.
When he's talking about from like the 2008 to even like 2015, probably 2016 range, like that's when the market was probably evolving and finding this hard money space. And it was very cowboy. It was very private. It was and now we're seeing a lot of institutional capital come into the market on hard money. Yeah. So, and when you Google hard money, it's hard to tell at times, like, what's private and what's institutional. They all call themselves hard money. I mean, they are trying to get away from the term hard money and the institutional side. How to make money with hard money. We're not going anywhere with that name. So we're sticking with it. But the easiest way to say it is like, we're asset-backed lenders, and what we call them is like hybrid lenders, where they're looking at the asset and qualifying the borrower.
Sure.
So, we say it everywhere. It's all over our website, no credit, no appraisals, no bank restrictions, no liquidity requirements, no tax returns. Like, if we're not looking for any of that, we're strictly vetting the asset. So we lend against the asset. There are personal guarantees involved, but when you're going for these, institutional grade products, you have credit scores, liquidity, and appraisals are three quick ones to say. Yeah. So that's like an easy way to understand the difference. And so what we say is like, understanding, if I'm a real estate investor or I'm a borrower, understanding like where the capital comes from is a big portion. So that's the shift right now, is that, and we've talked about it, I think, previously, but they're trying to securitize hard money loans and be able to sell them on the secondary markets and creating like a rating system for them. Sure. And once that happens, it opens the door, and is opening the door for institutional grade investors like insurance companies and private equity to come in. And so that can drive costs down for hard money loans, but also the qualifications increase. And so that, to me, it creates like a divide in the market. And so, a lot of the loans we can close, we call them capital markets. We can close these institutional loans as brokers, but our internal product, where we are the lender, is an asset-backed loan. And so it's strictly vetted on the asset. And that's when we have a lot more control. Yes, it's a lower loan to value, but it's just a different product. And so when the borrower understands the difference in products, then they can make better decisions on which deal requires which type of loan.
For sure. And I mean, I could speak on that from just the development side. Every deal is different. Everybody knows that. So as you're coming up to these deals, being able to work with a group that has the flexibility to provide different products based on what fits the situation is phenomenal.
Yep. So understanding the market is probably where that starts. And that's certainly the biggest shift that we've seen over the last 5-10 years. And I think we're going to continue to see that shift in the next coming 5 to 10 years.
Absolutely. I think there's going to be a lot more of that going on. So I think too, for our borrower base, it's important for them to really understand that and start identifying those, because once they identify them and understanding what tool to use in the right moment, they can really get themselves a lot of, capital savings. Sure. Because, I mean, there's a lot of times where David and I will get a call with an investor and they know it's just about speed, not about cost. It's just about speed. And they're saying, Caleb, look, if I can close this loan now, I'll get $50,000 off the purchase price. I don't care that it might cost me 20 grand in closing costs or whatever it might cost, but I'll save myself 30 on the bottom line. So let's get it closed.
And a lot of times the cost isn't that drastic. I mean, if you're comparing like a fix and flip product, right? Let's say it's typically like a leverage thing. Yeah. Like the institutional hard money might go 85% of the purchase price, 90% of the purchase price, and 100% construction financing, where we're going to be at like 70% purchase, 50% construction. Sure. So they have to put more cash down with us. But to your point, they can close in 3 to 5 days. The institutional product may take 21 to 30 days. So if you can get, it's more like cash on cash return and understanding your leverage is what I would say. Because still the rates and points are comparable.
For sure. They're not drastically different. You're talking a couple of percent here, up or down. So it's not the end of the world. But yet again, knowing the product and the ability and when to pull which lever is huge in how you make offers for buying real estate in general.
Yeah. Caleb, how do you think just regulation and technology play a factor into where this industry is going and different trends that you're seeing right now?
Well, to regulation, like Dave said before, securitization of these loans is happening. Whether we like it or not, it's happening. And insurance companies are buying these loans in the secondary. It's just evolving in that direction. So in order to do that, they have to, have, buy boxes. So they have to have standards of, okay, it has to have this sort of FICO score. It has to have this sort of LTV. So when you start doing that, regulation is required. You're going to need technology and software to have these guidelines met and saying, okay, I came to this loan to value because I have this sort of technology that proves this is correct.
Yeah.
I ran this FICO score with TransUnion, Experian, Equifax that qualifies for this. And then I provided this bank statement from Bank of America that shows 6 months of liquidity. So when you start having these buy boxes for the secondary is when the regulation starts. And then the technology comes into place where someone has to qualify that. And it can't be some third party, random person that said, oh, I saw that, thank you, check the box. There's no proof. So the technology comes into play to say, I ran this report using this software and this process to qualify. So
appraisals, especially.
You're seeing desktop appraisals.
In markets that you're not familiar with, that's when technology, AI, you're getting so much more data on the assets now that you can, be more accurate with an appraisal in Ohio when you're a Florida lender, perhaps, because of the amount of data you get through these new softwares.
Well, and talk about that too with the software, like on the inspections. You guys made a big shift on that using a different software. You want to tell them a little bit about that?
Yeah, so I mean, we use a combination of different softwares even. We're still using MLS. Like I said, we don't require appraisals here in the state of Florida, but we're underwriting, Caleb and I are underwriting internally. And so we're using richer values software. We're using MLS, public data as well. So we're kind of looking at a number of different metrics to come up with our opinion of value. We have a process we go through as well that sometimes we find our valuations are quite different. Some appraisals. I mean, we had a story this week where we're almost 50% off on valuations and there's pretty clear comps. So you wonder where they're getting, so that's kind of a risk threshold thing. It's like these institutional grade investors, how accurate are they at scale and volume, and that's why, we're not doing $14 billion worth of transactions like Lima One is. So, we feel like we can be more accurate in the state of Florida. And that's why our asset-backed product is not in Ohio. So anyways, I think that's interesting. And I think you're going to keep seeing that evolve. And some of these softwares are pretty new too. We're using
inspection software. That's really helpful.
SiteWire is now like third party. They're using AI that basically can, geotag the location so the borrower can submit their own inspections and it kind of mirrors it, or it connects, I should say, with Google Places. So it knows, you take some pictures of the property, make sure you're actually at the right property. And that allows these borrowers to, get their construction draws much quicker.
For sure.
And so speed is everything, especially with construction. We know how the subs need, better than anybody. Subs need to be paid quickly. So I'd even go back to some of the different uses of why somebody may use private asset-backed loans versus more institutional grade. I mean, I know you can speak to this as well. So I think we talk about that for a second. The fix and flip product, let's just use that to start with. We're not seeing a high volume of fix and flip in 2024 for our asset-backed product that we had in 21 to 23. But we are seeing those products in capital markets. Or in these institutional grade, the
higher leverage.
Yeah, and I think a lot of that has to do with what you were saying is the cash on cash return, right? So when people are going to these fix and flip products and the margins for these fix and flips have, dwindled. I mean, they're not as big as they used to be. So velocity becomes a huge thing, right? You have to turn these fix and flips a lot more and a lot faster, which then your cash on cash return will matter. Right. So
the less cash you have in the deal, you can take a smaller margin and then volume and velocity.
Exactly. So and then the only other way to combat that is then if you're using an asset-backed product where, the distress of the seller will matter, where you can close faster on the product to maybe get a lower purchase price And then maybe the asset-backed loan in a fix and flip scenario will play a better role.
Yeah, but even then, we're seeing a lot of fix and lease type products. You go in, you buy it, and you have to stabilize the assets and then refinance to a DSCR loan, a 30-year amortized mortgage, or even just refinancing. Death, probate, divorce, estates. Like some of these just don't qualify for that type of product. So you need a lender who can come in and close with special circumstances.
For sure.
And then, Mike, I'll even ask you the new construction product. We're growing our new construction business on the development side. Why do you use this product versus that product? In what instances?
Yeah, it's really based on the deal. But again, it's like, what is the deal structure? I think it all goes back to structure. How was the land purchased? Do we own the land outright? If so, then we can use it as leverage to, get a higher leverage construction loan. Or are we, putting our own cash up? There's just different ways to structure the deal based on, what's available.
Speak about Dutch versus non-Dutch.
That's a good point. So Dutch versus non-Dutch interest. They're, especially on these larger construction projects, if you're paying Dutch interest on a construction loan and you're paying for the full amount of the construction loan from day one, that's a pretty heavy interest payment.
Yeah.
If you've got a $4 million
kills
budget.
A lot of deals.
Yeah. So being able to have access to non-Dutch products where you're only paying on the money that you're drawing down changes the deal quite a bit, and it really reduces your cost of money on the project.
Absolutely. And then even so the loan size is what I'm hearing you say too. Because
for sure.
You get a $200,000 loan on construction and you've already gotten to block slab frame.
It just doesn't really matter.
You can speed velocity.
You're going to finish that in 4 to 6 months. You're going to go right through it. So it's like, to even bother with, trying to get the higher leverage non-Dutch, sometimes it's just
the cost is barely even affecting the deal. So,
and like you said, speed is everything. So it's what can get me to where I want to go the fastest.
Absolutely.
Yeah. And I think going to a big advantage for DKC and how I believe the economy has changed, or hard money lending has changed in general, is having a lender who just doesn't specialize in hard money loans. Like, we specialize in hard money loans, that's our bread and butter. But we have great understanding to what capital markets provides, which entails when our clients come to us, we know how they're going to, refinance with a DSCR.
Exit the loans.
And exit these loans. So when we're shaping up our hard money loan and we're looking at their exit in the plan, it will cater to being able to qualify for the loan.
Yeah. Sure.
So we can aid our clients to be successful throughout the whole investment. Not just say, okay, we're going to give this to you, and what happens, the next step is good luck for you.
A lot of times that will end in a foreclosure if they don't have the right plan.
Right plan. And that's where, having a lender like us is huge, because you just don't want to be with someone who doesn't have to give you the outs, right? Because we all know in real estate, it's unpredictable.
Yeah.
Even on extensions and things like that, understanding, like right now we have borrowers who, got jammed up in their projects on the 1-year bridge loans, and, they're unable to refinance because we just had 2 big hurricanes, right?
Right.
We're underwriting deals right now. There's a lot of hurricane damage, got stalled out with permits and things like that. And so, we're allowing flexibility on extending loans to give them more time. Otherwise, a lot of other private lenders will just say, time's up. You got to refi or sell. And that costs a lot of money.
For sure.
And I think our extension terms are very favorable as well, because we want the success of the borrower. We talk about this all the time, but we'd rather extend the borrower for a smaller margin than get the cash back and recycle at a higher margin, because we value the relationships with the borrowers.
Absolutely.
And so I think our borrowers are appreciative of that, I hope. And that's something we want to continue to do and provide some flexibility. And then there's also times where, look, we understand, as you mentioned, we understand there is no exit in sight on a refinance, so you must sell. Yeah. And so we're going to give that guidance as well. And otherwise it won't end well for them. Yeah. So understanding the exits and understanding what construction looks like is, I think, quite valuable to the borrowers.
Yeah. And these things, being in these situations is why having an intimate relationship with your lender matters. For sure. Because what happens if there is an event like the hurricane or something, and you're just one of a billion numbers on a loan application? How much leverage do you think you have as a client to be able to get an exception from a bank? None. There is none. Yeah. That's why that hard money relationship matters, and we can help that way.
And we talk about it all the time. This is a relationship business. The more when you close, you have a successful project, you pay the loan off and you go again. We have a higher level of comfort with that borrower, and we can, try to increase our terms and be more favorable. And look, we want to have borrowers that continue to borrow from us. We're not looking for one-time borrowers. Sure. So it goes both ways in that manner.
That's really good. Yeah. And I think being able to is working with a group like you guys of being able to give the borrowers advice. You know, it's like you said, Caleb, things happen all the time.
Right.
You're going to run into issues. So being able to have that flexibility and look at different options, maybe it's an extension or switching and doing a loan mod into a different loan product, it provides a lot of flexibility for the borrower.
Yeah.
So
yeah, I mean, that's a loan mods. We didn't even, that's a good point too. I mean, we're doing a couple, I mean, especially on our new construction products, you do a loan, we're doing a loan mod this week where borrower, you know, when we closed the initial loan, it was probably in block slab frame stage.
Okay.
He's since, you know, drawn down the funds and the property has a CO, it's on the market for sale and he wants to close on his next lot. So we're loan modding him, increasing the loan amount, letting him cash out to then go buy his next lot to keep his, I mean, as a builder,
really helpful.
As a builder, the velocity of keeping projects going matters a lot. So
that's, and being able to act on the deals when you find them too. That's a big part of it.
Big time. Big time.
So available capital. One thing we touched on is technology. And I know that you guys have kind of gone on this path of creating this portal. Do you want to talk a little bit about that and how technology is impacting your business and what you're doing about it to make it easier for your clients?
Yeah. I don't know if I want to talk about it. It's been a long journey. We're like 3 years in, but no, we've been developing software for some time now and it's definitely in its final stages now. So it's a loan servicing portal. That's basically, we call it the LSP, loan servicing platform. And it's allowing us to scale our business and still provide a high level of customer service to the borrowers and a higher level of compliance to our investors. And so, you know, everything from tax, insurance, collections, you know, that type of compliance, issuing draws, managing draw schedules through our trust accounts. And so it's been catered towards our business and how we raise capital and how we manage, because there are other softwares out there, but we took a lot of time and money and effort to kind of go through to try to build out this product. And our investors have like a banking login, just like they would if they had a Merrill Lynch account. And so, you know, yeah, we try to stay on the front foot. And I know I can tell you from 3 years in the software that it probably never ends, unfortunately. And, you know, every time Caleb comes up with a new loan product, I got to try to build it into the back end. We're going to do triple loan mods in 1 month this past. So like that was the newest feature that we had to build in, but Caleb's keeping me on my toes there.
That's right. Well, thank God for David, though. You always handle me with grace.
Well, you have a lot of creativity. So we appreciate that. You're the one to get deals done. So
that's right. That's right. Drive.
So even like, I mean, maybe you can speak on like our ability to close unique files. I mean, you know, that's a value to the borrowers. Like, how are we managing? Because I'm always thinking about it on the operational side, how we're managing open code violations, permits, you know, blah, blah, blah. So
yeah, I think that goes.
Speak about that.
Yeah, I mean, I think that goes back into the unpredictability of real estate. You know, you never know what's going on. You run a title report, you don't know exactly what's going to pop up on this title report. Could be a code violation.
Or the lien search. Right?
Yeah, or the lien search. I mean, once you go through that process, it could be, oh, that's $50,000 more worth of debt, or we have to negotiate that. But, you know, the creativity of us as a lender, when you go through underwriting with a bank, it's stringent on what that is. With us, when something pops up, we can say, okay, let's mitigate that. Do we need to infuse more capital? Do we need a larger draw schedule? We can make the adjustments that no one else, well, not no one else can, but a hard money lender could, you know, can. And having the softwares and technology to do it helps us out a lot, you know.
The GC license and understanding too, because like, why can we do it? I think is important for them to understand. It's like, well, why can you close with an expired permit?
Yeah, I mean, the biggest thing is because we know what it takes to satisfy that open permit.
For sure.
So that's the biggest thing. And we're also local investors into our market. Yeah. So we have the intimate data of the actual locations where we're like, oh, okay, we're used to dealing with Hillsborough County. We're used to dealing with Pinellas, you know, or Polk, whatever it might be. Yep. But we know what it's going to take. We might even know an inspector or two, or we can even ask you, you know, as our development partner, hey, Mike, how many times do I call you a week and say, this borrower has such and such going on. They told me this narrative and this story. Mike, you know, I don't know. What can you give?
They're lying.
Yeah. And then you tell me what it really takes. And then I can go back to this borrower who might have no experience. I mean, that's a big thing with us. We deal with newbie clients. I mean,
talk about that. I mean, that's a huge gap in the market where you have a lot of people that are looking at new construction and want to get into that sector right now. How can you help those clients that might not have the experience that most lenders look for?
So, you know, with that is sharing our experiences, right? Sharing what we've been through. And even going over with lifetime examples of projects that you were actually doing with us.
Sure.
So, you know, going with the borrowers and they set forth their plan. Once we see inconsistencies of the plan, because we know David, he could pick them apart piece by piece. And he always tells me, Caleb, no, that's not going to work. And once I start going through the plan, I can give advice that we have backed with data, right? Because that's the other thing. We're not just giving advice here or giving instruction just because we want to and we believe it's the right thing. We know it to be true by practice, because that's what we do.
Yeah, I could even add to that because like I think everything's like top down. Everything kind of starts with the capital. Yeah. Because even if you give them a good plan, I hate to say it, but like we have the hit by the bus protocol where it's you gave them a great plan, well done, and then they walk out the title company, get hit by a bus. Right. Now what?
Now what?
Right? So it all comes from the capital's perspective. It's like, how do you mitigate risk? Well, if you have a GC license and a development partner where, God forbid something happens, because like, look, life happens and we can't guarantee that somebody doesn't go through a divorce, have some sort of life-altering event that they're no longer able to execute on the plan. Mm-hmm. And so the reality is that's why we're able to offer these products to people who may not have the experience, because in a worst case scenario, we know we can step in and finish the project. And that provides a level of comfort for our investors for us to provide the capital. Yeah. So I think that's really where it comes from as well. Yeah. And then on top of that, you're always giving them great plans and allowing them a different perspective to then execute on. Yeah. Yeah. And I think that's what shaped it, is because you were always raising the capital. So you have that insight of how it is. And I was always originating. So that marriage has always done us well and why we've thrived in this market. And those perspectives have stood true and why I think DKC has been super successful. Yeah.
How do you think the director lender model influences your decision-making on these loans?
Meaning like we are the lender and not brokering them out.
Yeah. Not having to like sell it to a secondary or things like that.
Yeah. Like the decision-making process is like, if we created a problem, I know not that brokers don't like want to create problems, but like, once they close the loan and they get past a certain, let's call it the first 3 to 6 months of the loan, it really isn't their problem anymore. So whatever happens after that, they're moving on and closing the next loan. Whereas, these are sitting on our balance sheet and our portfolio and we're managing these things through all the way to maturity. So at the end of the day, if there is a problem that's going to arise, it becomes our problem. And like I said, we are partners to our borrowers. We don't, so, their problem's our problem. And so we really want to guide them because we want repeat clients. We want them to be successful. We don't want to have issues that then fall back on our lap. And then at the end of the day, if something happens and there's a foreclosure, which is the worst case scenario, if it doesn't get sold at auction, that we literally own that asset. So are we comfortable owning the asset at the loan to value that we're at? And understanding true cost of foreclosures too. That's something that we've continued to grow and learn. That I think, and that's changed too over the last 5 years. But I think some brokers don't necessarily understand the true cost of foreclosures and what that looks like, and owning the asset at the end of the day.
Yeah, and then I also think too with brokers is once they fund the loan with a larger outfit, this borrower now has access to this larger outfit or this bank, and they may go directly to them. Mm-hmm. And you think the bank cares about that broker? Maybe not. With us, we really create those, relationships with the broker where it's like, oh, you brought us this client, and then we can service them throughout. Because remember, this client is not just calling a 1-800 number.
Sure.
They know our team and they know our staff, throughout the process, and they can call us for direct answers. And then if there is a new loan present, we can contact the broker and say, hey, your client's looking for so-and-so and so. We would like to service them again. Absolutely. And it's an ongoing circle and cycle where the broker is never totally diminished and out of the picture. They can continue to make their commissions. The client continues to get service, by DKC, and everyone continues to make money together. And in essence, we all grow together and we all know each other.
Absolutely. The brokers are critical to the process and provide a great role in service. And so those relationships are very valuable to us and something that we hold to a high regard.
Yeah. I can't tell you how many times all of a sudden I've dropped a check on a broker. They had no idea deal closed. And then me and David sit there and go, oh, so-and-so called thanking us. I'm like, yeah, this is what we do. Yeah. We always give back.
Love that. What do you think sets DKC Lending apart from other private lenders in the market?
A lot of those things we discussed as far as like the development background, the direct to lender nature, and but also our willingness to try to innovate and grow and shift into new products. I think we've evolved a lot in the last couple of years on our products and our offerings. And I think that's interesting of where we're going as well. What products could be out there in the future is something, like I said, Caleb is quite creative and has a lot of great ideas. And so
personalized consulting.
Yeah.
Well, his grades are growing by the minute with everything.
So, Caleb, where can we go even in the future? What are some of the products that you see that may continue to evolve?
Well, something I've been talking about for like 8 years now is a 30-year hard money product. And I know I'm just, speaking it into existence, but it's always something that I felt was a need in the market. And I know they're trying to satisfy it a little bit with DSCR, but that's not really a true hard money product. Truly having a long-term 30-year hard money qualified product, I think is something for the future, but not right now. That's something that I see coming in the near future.
Yeah.
But then also I would ask you, Dave, is how do you think customized loan products have helped us? Because that's a big thing too, is understanding that all products aren't the same and we don't fit right in that box.
Yeah, I mean, we've certainly have some creative loans on our portfolio, and credit to our investors as well, who are quite creative and understand how they're real estate investors as well. You know, not that they're, and we have non-real estate investors.
Yeah.
Also, but their trust in us, and then their also ability and willingness to step into the creative boxes. And like, we've opened some unique offerings. I mean, we've done cross collateralizations in different states, and hybrids between first and second mortgages, and even some primaries with investment collateral. So we've really stepped into some creative spaces, and that's something we want to continue to try to evolve to. But at the end of the day, it's like, that's what these deals needed to get closed, and that's what it was required. And we wanted to help the clients and try to, and that's why I say you're quite creative, because this is what we can do. These are the factors we're looking at, and how do we make it work? And that's what we try to do best. And like, there's some interesting other products out there, like the bridge buyback or the auction product, that are, I'd say, like, there's not really a hard money loan product for the auction.
Yeah.
The auction, you don't get title insurance, which is the main reason.
Mm-hmm.
So can you buy something without title insurance and get a mortgage? That's been something
Typically not.
Yeah. I mean, that's not something that I've seen in the market yet. Something that we have a couple ideas up our sleeve there. See if we can make work with I think it's hard to do that at scale nationally, but like in a local market, I think that's pretty interesting. And then a bridge buyback, being able to offer a higher loan to value, but, different deed structures to have more of a partnership with the borrower versus true lender-borrower relationship. I think those are just some topics that we can probably explore in the future, and we have been.
Yeah.
Still evolving.
Yeah.
That's great. What do you guys see as the future trends in the hard money space? Let's say the next 5 to 10 years. What do you feel like that looks like?
Well, I mean, for me, I think there's always going to be a space for true private hard money. I don't think we're going anywhere, because you're always going to have a distressed asset that won't qualify, in some of these hybrid lenders, box. So I think private and hard money goes nowhere. But
I'd even add like asset backed.
Oh yeah, asset backed, for sure.
Because that's what you mean, I know.
Yeah, and that's what I mean. Yeah, asset backed, no credit score, no appraisal, none of those things. So and not passing a 4-point inspection.
Sure.
So that's what I mean by true hard money and private, is under those circumstances. Next, I mean, technology will always drive change, right?
Sure.
And no matter how much a hard money lender wants to stay as an asset-backed lender, we will adopt with the technologies, to stay at the best of our game, because speed matters, right? Especially in the hard money business. Why have we taken on, for example, a richer value software? Well, for speed. So we can do desktop underwriting and evaluate a property within 60 minutes of time if we need to.
Build in confidence.
And then at the same time be accurate, because that's where David has been, instrumental for our growth as a company, where we can have a process in place that will spit out consistent results, right? Because you don't want to have to do a new process every time and use different softwares every time and reevaluate a deal differently every situation.
Sure.
We go through our process every time to get a consistent result and be able to protect our customers and the client and protect our investors at the same time. So I think that's really been huge, and us adapting to that has helped us with our speed and helped us to fund good quality deals. So in essence, protecting all.
Yeah, and creating some consistency from a client's perspective, borrower and investor.
Yeah, because they know what to expect. Yeah. Right? Like a lot of our clients now, when they say, oh, Caleb, I need to close this deal in 7 days. Great. Well, I need, the application, I need to evaluate the property. I need some pictures or an inspection, and how, you contact Marta in our processing staff. You know the drill. So it's created that consistency where people can also, bank their business on the way they qualify with us.
Yeah.
So they can continue to grow knowing what they're going to get with us. And at the same time, Dave, what do you think is going to happen, on your side with raising money, process technology, and the growth?
Yeah, I think like the biggest shift for the future is like the securitization of hard money loans and the grading of the paper, and seeing maybe a split in the market of the institutional institutional hard money versus the private asset backed hard money. Okay. I think that divide will continue to grow, and there will be cost differences as well, like qualification differences, asset type. I mean, commercial assets are very difficult to get done on the institutional side. I know that's something from a capital raise perspective is getting more comfortable and growing towards commercial lending for us versus, a big percentage of our portfolio is on residential assets. Mm-hmm. And so I think growing towards commercial assets is something that the market will need as well, mm-hmm. Because the banks, I mean, you say commercial, they're kicking you out the office right now. Right. So I think like that's like interesting is where does private hard money fill the void on commercial? And then how do you qualify and what's the difference in cost going to be for the asset backed lending versus the hybrid?
And just for the audience, when you say grading paper, what do you mean by that?
Yeah, they're aiming to create, just like they did in 2008, and currently still do with all of the conventional mortgages. They grade the paper and, A, B, C, D, and the qualifications of, A being the highest rated paper, lowest risk. And so there are risk correlations. I mean, maybe you can speak to that from a conventional perspective of how they grade it.
Goes back to all the qualifications I was saying, credit score, appraised value and loan to value, your income documentation. So the more qualifications you could provide and have verified, because it's really the verification of it too, because back when the market crashes, they were verbally and on paper writing what they were, but it wasn't backed with, okay, make $1 million a year. It wasn't a tax return that showed $1 million a year. Sure. It was just a 1003 that
trust me.
Yeah, trust me. It was that. It was trust me. So the level of verification and how many you could actually put on paper is how they'll grade.
So the higher the credit score, the lower the loan to value, the more experience, the higher the grading of the paper. And so and the better terms that borrower will get.
Absolutely.
But I still think there will be the deal will dictate which way they go, because you can have the greatest credit and the most experience and tons of liquidity and want that higher leverage. But if you have to close in 3 days, I'm not sure they're going to be able to do it. And that's where private asset-backed lending will always stay true.
Yeah.
Yep.
I definitely agree with that. I feel like it bridges a really big gap in the industry, especially for all these different deals, the ones that need to close quick. You talk about getting discounts on purchase prices and being able to have that leverage when you're negotiating, knowing that you have a lender on your side that can get the deal done quickly makes a big difference.
Yeah, and I think people have so many misconceptions too, because we spoke about this on a couple of our podcasts previously. It's like, who is your borrower? And a lot of the times people are like, oh, it's some person, distressed investor that has nowhere to go, and it's not really the truth.
Yeah.
I think people need to realize what we were talking about earlier in the sense of knowing what tool and what lever to pull. We have very, high net worth clients that use our product. Big time investors have hundreds and even thousands of flips under their belt that use our product. But then we have the new experienced first time flipper or the first time builder. So I really think, I implore and I push people to really learn about the product, because having it in your toolkit will only lead to bigger profits for you if you understand it enough.
That's a great point.
Nothing to add to that. That's brilliant. Well done. All right, very good. Well, I think that was a great conversation today. Something we'll continue to keep an eye on the market and see where this goes, especially from the institutional private space. But this has been a great conversation. So thanks for joining us today,
Love
Mike.
You guys. Thank you.
All right, thank you.
Come, Mike.
Thanks for joining us for another episode of How to Make Money with Hard Money. Like, subscribe, and follow on all social media platforms. And you can catch this podcast on Apple Podcast and YouTube.